Hello, everybody. This is Baldwin Berges, and I'm here along with my colleague Zin Bekkali. We're going to talk about African fixed income today. If you're listening to the audio version of this, make sure to also check out the narrated slideshow on our Frontier Markets Insights tab on the Silk Invest website. It has visuals that you will probably find interesting. But Zin, let's get into the topic. How are you today?
Very good. Thank you very much, Baldwin.
Very good. Let's go. Let's talk about the African markets are increasing the spotlight, and most of the attention is really going to the equity space. But at Silk Invest, we believe that there is a very interesting opportunity for investors in the bond markets as well. And I think our title today, Good Credit, High Yield, sort of speaks for itself. And we're going to be exploring a set of opportunities that somehow remind us of where emerging market debt used to be, not really that long ago. And another interesting timing for this conversation is also that as we speak, the US is undergoing a shutdown with a talk about missing a debt payment as the government bumps up to its debt ceiling. So even though it's kind of hard to make sense of it all, markets ignore fundamentals. And even more surprisingly, I guess what we're also seeing in the market is that treasury yields have actually moved to lower levels. And I think what we want to draw on attention today is to another sort of anomaly in our minds, at least, where issuers that are really good for the money are forced to pay higher yields for their debt. So this creates an efficiency that, in our opinion, it does create an interesting investment opportunity. Now, so we're going to be focusing on African sovereign debt in this presentation, and more specifically on the local fixed income space. Zed, tell us a bit more about how Silk Invest came to focusing specifically on this space.
Yeah, by the way, I mean, we have been working on this new product for a long period of time. We have been one of the first, or probably the first company to launch a frontier markets bond fund already more than 3 years ago. So basically, we have been really innovating this space for a long period. And within that frontier fund, African local currency side has been always the most attractive and most interesting. And as you rightly said, as of today, in a world where you have to pay, you don't have really a lot of fixed income opportunities, this space makes a lot of sense. Essentially, in a nutshell, we are talking about a universe which offers investors, on average, anything between 12 to 15% yield to maturity in an environment where these countries are today with very strong reserves, good fundamentals, and increasingly improving governance structures, lower inflation rates, and increasing investor appetite. So we believe we are really close to a tipping point with regards to Africa bond markets, and investors should look at this more and more.
So, okay, let's have a look at let's have a look. So what we're looking at here is we're looking at high returns. We're looking at three elements here, right? We're looking at high yields, we're looking at currencies, and we're looking at essentially, good credit profiles. Tell us a little bit more about that.
Yeah, so if you look at slide 4, and this really gives a good summary of what we want to discuss today. The starting point is that these markets offer the richest yield that you can get in globally speaking. So essentially, you don't find any region outside of Africa where you still can get in certain countries up to 17%, sometimes 20% yields on sovereign bonds. Those are local currencies, but still 17 or 20% is very, very rich by any definition. The second point is we look at the currency side of things. We believe that these currencies are very undervalued. They are undervalued versus historical levels, but also undervalued versus the rest of the world. But even if you don't assume that these currencies will appreciate, it's still a very interesting story. And the final one is really around the potential, the significant potential for spread tightening. So maybe we want us to go step by step into these 3 points. The first point is with regards to the rich yields, and you see that in this space. If you look at the African local currency side, the local sovereigns, on average, basically, look at the universe of these countries, you have anything between 17.5% for Ghana and going down to 6% for Botswana, with Nigeria being almost like a medium country, or 13% average on the local currency bonds. Now, that's a very, very rich number.
What we're looking at here, are these central bank rates or are these further up the curve?
No, those are basically the universe that you can get as an investor. So that's basically the average of outstanding debt instruments in these countries.
Okay.
So if you go to the slide afterwards, in slide 6, you see the official central bank rate, which is basically a bit lower than what you can get in the bond market. And what you see there in this slide, the most important message there is if you compare the official central bank rate with the CPI or the inflation, you see a huge disconnect. And you see that these countries really are offering rich real yields. So if you basically look at the inflation rates and look at the yields, and you look at the difference between the two, you see that many countries are offering anything between 1 to up to 8% real yields. And that is something which we think is an anomaly and will eventually disappear.
Yeah, that stands as a very stark contrast into what we're actually getting in a lot of developed markets where the real yields are actually negative.
Yeah, sometimes significantly negative. So that is something which is really interesting, as you state. And the other point is also, if you look at slide 7, is that inflation rates in most African countries are coming down. So if you look at 2008, the average in some of those countries was around 18%, and today it's 9.5%. So basically, almost halving of inflation in a very short period of time, and that trend will continue. We expect, if you look at this slide afterwards, is that the inflation rates will move from around 12% to only 7% in the coming 4 years. And that is something which really sets the scene for what we believe going to be one of the best performing bond markets in the world.
And what is usually driving this drop in yields, in inflation levels?
It's the real magic word in that sense, and you can keep it very short, is central banks. African central banks are probably the best institutions within the continent, and whether it is Nigeria with Sanusi, which, as some people know, have been elected best central bank governor in the world, or somebody even in Egypt or in Kenya, people are starting to understand better how to control the money supply, understanding better how to control the monetary systems and have more discipline to control this. And that is something which we have made had a tremendous impact on inflation rates in most of these countries.
I guess that's fair. It's an upward learning curve provoking a downward inflation trend.
Sure. Yeah. And the other thing, so basically to come back to the currency side, which is to a certain degree also very much links back to the same central banks, is if you look at most African countries today are selling close to the lowest point ever. So essentially they have not appreciated at all of the last 10 years. In fact, they are depreciating. And if you compare, for example, that with a market like Brazil, which even after this correction that we have seen is still 35% higher than its lowest points. So basically African countries are at close to 0% versus their lowest point ever, versus Brazil is it's still 35% higher than its lowest points. If you go to the other slide also, and that is a more technical argument, but basically if you look at what can you buy with $1 in most of these countries, you see that you can get more products. This is purchasing power parity conversion levels. You can get more products for the same dollar in most of these markets.
And then individually between them, there's not much correlation either. So you do have a diversification effect on top, right?
Yes, Baldwin. And if you go to slide 11, you see that very much mentioned or quantified. Essentially, if you look at the period pre-2008, the average correlation between those currencies was 4%. The median correlation was only 1%. Even if you take a longer period, 2003, 2013, which is basically the baseline which we use, the correlation has been only around 5 to 6%, which is by all means extremely low. And it's almost like a diversification dream where you have countries who basically show negative correlation with each other, and that is essentially what Africa gives you. Now you may ask yourself, why is that the case? And most of it is really driven by the fact that these countries are still very much internally focused. Many of their factors, macroeconomic factors, are again internally driven. So you have local currencies, local weather conditions, local political systems, local economic systems, and is something which is quite unique in that area. This correlation will go up for sure in the future, but still it is very, very low and very much less related to what has happened globally, because they tend to be not the typical export-oriented economies that we see in other places.
Yeah, and they're very vastly different places as well in their makeup, right? I guess
Of
people tend
course,
to throw it in one bucket, but yeah, Kenya cannot be at all compared to Nigeria by no means by its the structure of its economy. So that
sure.
will always sort of guarantee that you're going to have a sort of a low correlation, I guess, right?
Yes. Yeah.
And they have money.
Yeah, I think that is again a factor which is really differentiates this space from the rest, is that Africa is still very much lowly leveraged, and more importantly, they have reserves. So most African countries, if they decide tomorrow to pay off their external debt completely, they are able to do that by simply going to the central bank. And in fact, if you compare the FX reserves to the external debt, many countries have a higher coverage. And take a country like Nigeria, where the coverage is more than 5 times, or a country like Botswana, which is even more than close to 25 times. So those are very interesting numbers to have for investors to look at when they are analyzing this space. If you go to the slide afterwards, you see also that besides the reserves, the monetary reserves that they have also commodities, which gives them another area.
It's their
Or another
alternative to
balance
tax,
sheet
right?
item. Not, yeah, you can say that like that, but the more important thing for us is that essentially, if they issue a bond, they should be able to pay it off more quickly. And if something happens, if they don't have the money for it, they still have the commodities, and eventually they should be. It's a balance sheet item. That's essentially the
It's a
story there.
collateral, absolutely. Mhm.
Exactly. Yes. Yes.
Okay.
And essentially, if you see, then the next point is that African countries have started to engage with rating agencies. And although as a firm we are not fans of them, it still gives an idea that today 17 African countries are already rated, which is really a strong element, because just a couple of years ago this map would have been almost completely empty. So
No, that
things
is a
have,
big achievement. You're right. That isn't because there are 54 countries in this continent, and to have almost half of them rated in less than half a decade, that's quite an achievement.
yes, absolutely, absolutely, and we'll see. We think that basically we have now around the third, let's say, of countries rated, and we believe that will continue. And in the coming 5 years, we would not be surprised if at least two-thirds of African countries will be rated.
Mm.
And the final thing, which is also important, is if you look at the two things which are interesting, is that there is local pension fund assets demand for this asset class, and that's really developing very quickly. Take a country like Nigeria, where pension fund assets were 5 billion in 2007. In 2012, it was already close to 17 billion, and we'll close the year probably around 20 billion, which basically means that in a period around 6 years, 5, 6 years, you have close to 4 times more pension fund assets in a country, and most of these pension fund assets are basically investing in fixed income. So this gives a very strong demand for these fixed income instruments.
Yeah, they match with the liabilities in their own currency, and that's. But so this is all pensions, or would this also include insurance premiums?
Those are really pension fund assets. So
Okay.
really the pension funds. So we are not talking here about the other institutional investors like the banks, like the insurers, let's say the non-pension fund insurance money. And have a look at the next slide, because it's also interesting.
Mm.
You see in that slide how the universe has grown. Because essentially, if you look at slide 16, in 2002 we had 34 billion outstanding debt in the whole of Africa. Today, it's close to 400 billion, and this is mainly driven by, on the one hand, the development of financial institutions, being the banks, being the insurance companies, but also very much driven by the fact that these countries are starting to build up a yield curve. And if you look at the issuance that's issued, and you see that below, it has been, especially over the last few years, very consistent. We have anything between 70, 80 billion every year of new debt being issued. And that is another factor which is really good, because it helps to deepen the universe, and it helps also to attract international investors.
Absolutely. Yeah, that's a liquidity factor that everybody is so curious about. And By the looks of
Absolutely.
it, if the debt outstanding can grow tenfold in 10 years, that the liquidity part is looking pretty good for the future.
Yeah, and it's already looking good today. I mean, essentially, the total African outstanding debt today is around the same 20% of the level the whole of the EMD universe was in 2002. So essentially, we have already 20% of the global emerging market debt universe. And probably Africa as today has more outstanding debt than LATAM was in 2002 or some other regions in the world. And that is just a good number to look at and gives you an idea that there is sufficient liquidity to build up institutional products for the market. And that essentially what we are currently as a firm looking into is to build a product for institutions investing in these debt markets.
Absolutely. And this is probably one of my favorites, you know. This puts a lot of perspective about everything we've just said.
Yeah, I mean that's really we are missing, by the way, one very important country, which is Nigeria. But it's really tells you the story. If you look at the U.S. or Italy, which huge debt to GDP levels and almost no interest rates, and on the other hand, you have our countries which have and a lower debt to GDP levels and typically higher bond yields. And that is something which investors are always missing. Also, take into account the fact that these countries have lower inflation rates and improving fundamentals. And you see that the conclusion is basically you can get in Africa an average of 12 to 15% yields with a much lower risk and a much lower correlation. And that is something which is quite exciting.
Absolutely. Okay, Zin, well, thanks for that. I hope you all found this insightful. It's a new space. We're very excited about it. Africa is, as you know, as Funmi, one of our portfolio managers, always says. I love it when she says, "It's not an investment destination; it's our home market." So we're on the ground there. As you can see, we have our offices across the continent. We're very keen on developing our fixed income range forward. By all means, if you would like to speak about this in more detail, do contact us. Our website is silkinvest.com, and feel free to write us. We'll be delighted to speak with you. Zin, thank you very much for this.
Okay, with pleasure. Thank you very much.